So the Federal Reserve wrapped up its last policy meeting of 2023 with another rate freeze and pivots toward cuts in 2024. For details, let's turn to Professor Kim Hwa-gyun. Thanks for coming onto our program.
My pleasure to talk to.
Professor Kim, as widely expected, there has been yet another rate freeze, but we all saw it coming though, right?
Yes, it was rather anticipated. For instance, according to the FedWatch, which is the CME's computation of the Fed funds rate not changing or changing the likelihood, and then it was over 99% about a week ago, so it was quite expected.
Right, and I want to point out how the central bank says inflation eased but remains elevated. What does this mean exactly?
So inflation now is around 3%, 3.1%. So compared to last year's like 9%, 6% type of the figures, clearly it's much more stable, which is a welcoming news. But inflation, as we know, is basically by definition the growth rate of price level. So as we experience like very significant increases in the last year and a half, the price is quite high at this stage. And unless we see negative inflation, we're not going to see this coming back down to lower levels. So that's actually what the Jerome Powell mean by the elevated.
Right, that must be in line with what he said himself, that the Fed doesn't need a recession to cut rates. Now, can we say that means there is a progress on inflation across all main core areas? Can we say that?
I think so. So according to data, according to the last November's the releases all across the board, including core inflation or CPI, PPI, all seem very positive and meaning that's much lower than expected. So I think significant improvement.
Right. What we did get out of Wednesday's meeting just hours ago is that there'll be 3 quarter-point cuts next year, but there's a divided outlook on when that will be. Some say as early as the first quarter of next year. Professor Kim, what's your outlook?
My outlook, I think, is mostly consistent with the first quarter of 2024, starting the first cut. The reason is inflation path, I think, has been stabilized. And I think it's going well into the direction of like around 2.5 or 2.2% next year. And the reason is at the end of the day, the money growth rate or supply of money changing speed is quite closely related to inflation at the end of the day in the long run. So we have seen the Fed balance sheet has been quite reduced, and also the banks, the balance sheet has been also decreased, meaning that the level of liquidity growth has been slower. So clearly inflation is going down. Given that, I think rate cut can happen as early as the first quarter. And also another reason, I think, is the spread between the long-term and short-term rate. So the treasuries actually is now negative, meaning the short-term interest rate is higher than long-term interest rate. Long-term interest rate, like 10-year, is around now 4%, while the short-term interest rate is around 5%. So somehow the market participants already started expecting that. I think it's going to go down to 4. So if the Fed actually started the lowering the rate relatively late, then I think there's some issues in terms of the making the goal of the lowering the interest rate successfully. So there's some non-trivial chance that the interest rate is going to go down a bit earlier than we expect.
Right, for sure, we'll have at least 3 quarter-point cuts next year. Is there any possibility that there'll be more than 3? What do you think, Professor Kim?
I think it's going to depend on the labor market. After all, the Fed's dual mandate principle is about inflation and then also the labor market stability. So
right.
If somehow the labor market is going, bad somehow next year because of this the high interest rate environment, then I think the Fed may just tap in the further interest rate decrease. That's somewhat expected, I think, in the yield curve that I just mentioned about the long-term, short-term interest rate, because the 30-year, 10-year interest rate actually is quite low.
Right. Speaking of the labor market, the Fed does believe the job market is finally easing into a so-called sweet spot. Could there be a turmoil in the labor market early next year? Do you think that could lead to a rate cut? What do you think?
It depends because surprisingly, the labor market of the U.S. Was not affected much and has been doing really well, despite that the very rapid increases in interest rates. So what the Fed actually initially worried about is the economy is not going down slowly, despite that interest rates going up very fast. But at the end of the day, if somehow the effect of monetary policy actually happened with lags, therefore, as you just mentioned, if somehow the labor market becomes deteriorated, actually even more than we expected next year, then I think the Fed is probably trying to go just lower the interest rate earlier and also more. But it's all going to depend on how the monetary policy and also the international shocks will affect the U.S. labor market in the next quarter. So I think the next quarter is going to be a very important focal point.
Definitely. Thank you so much for such a thorough analysis, Professor Kim. We appreciate it.
My pleasure, always.